Aloha everyone. I don't see how this video is going to be short. Wow. I tell you what, the 50-day moving average has been psychotic lately for the overall market. And just a quick glance, you can see how crazy it's been. In September we broke through it. In October we broke back through it again. December broke below it, back above it. Let's try it again in January. Okay, let's do it again in January. Okay, let's do it in February. The volatility in this market is absolutely insane and is typical of a market that has already been in a bear market for quite some time. And the fact that we're seeing this near the new highs, I don't know. At first I thought maybe it was potentially bullish, but what a difference a few sessions make. I am now outright very worried that we could see a crash in the short term, a la the move we saw in October again. This is ugly, guys, what happened today. We gapped up following the Apple earnings. And if this market was healthy, we should have taken off, following that market open. The fact that we didn't, and post-Fed, we didn't rally post-Fed, I can't personally remember the last time this has happened. And we sold off hard, and we did it after a hawkish Fed statement, even though the bond market called them liars, basically, by having yields race to lower lows. Something is extremely wrong, and without worldwide full frontal carnage and QE, I think that we're screwed, man. This is a bad situation. By the time Thursday happened, my God, it looked like that this was a successful test of the 100-day moving average, which I had a hard time believing since everyone saw it. But once we retook the 50-day moving average on strong volume, with all of our leading stocks that we had, I thought that we were off to the races. A re-breakdown below that now, very ugly. Our model will switch to a sell signal on the Nasdaq if we get below. I need my pointer. There we go. These lows right here. So we break the January lows. Sell signals in effect for the Nasdaq Composite. Russell 2000 breaking below the 200-day moving average initiates a sell signal on this index. The Dow Jones Industrial Average, similar situation. It's basically already under a sell signal for me. So as far as I'm concerned, I'm going to have to update my Twitter account and my analysis that I'm currently writing. Dow Jones Industrial Average is under a sell signal as of today, and that's perfect because I'm adding SDOW as a hedge right now to my long portfolio. And then the S&P 500, another ugly session. If it breaks the January lows, a sell signal will be triggered on this one. And one of the key things is I liked how the New York Stock Exchange held up yesterday to the selling, like the Russell 2000, and with them leading the downside today, Russell 2000, New York Stock Exchange, I'll tell you what, that's an extremely bearish omen. The heavier volume, remember I told you I was worried about the lack of positive divergence anywhere in TSV and MACD on any of these indexes, and now you know why I was worried about that we weren't getting confirmation with price action, because we're nowhere near oversold, and it looks like, yeah, our oscillators are telling us there's more downside before we get oversold whatsoever. And while I said that the advanced decline line has never triggered a market top whenever it's hitting new highs ever in the history of ever in the stock market has the advanced decline line been hitting new highs, and then the market tops out shortly after. So wouldn't it be quite wonderful and perfect and just, I guess you could say, perfect stock market-esque for us to actually top out with the advanced decline line hitting new highs? That would be funny. Not calling a top here, but I'm saying that we're set up for a big pullback. One of the important stocks I like to watch to make sure the market's healthy are bank stocks. Look at Bank of America. Look at Citigroup. Look at Goldman Sachs. Look at JP Morgan. Look at Wells Fargo. Look at Morgan Stanley. Does that look healthy? Does that look like a healthy market, a potential bottoming pattern in any of these? No, it looks like head and shoulder top rollovers across the board and just ugly price and volume action across the board. This is atrocious. Now let's go to some of our big cap stocks, the recent IPOs. Alibaba, oh, that's not looking too good. GoPro, not looking too good. Loco, not looking too good. Okay, what about Apple? Well, that wasn't a good session following the gap up. Microsoft, just kept on getting uglier. Cat, no follow through the upside there. How about Yahoo? Eeks, that doesn't look good. How about Google? Ah, that doesn't look good. How about Priceline? Nope, Doesn't look good. How about Tesla? Nope. Intel? Nope. That doesn't look good. Are you getting a picture here? Every big cap technology leader looks like crap. This is the market. Every bank stock looks like crap. This is the market. If they go, goodbye. And look at our leaders, home builders, not looking too good. DRN, XHB. Biotech is holding up, but even it had a distribution day today. So it's not out of the woods yet. And BIS off the lows, nice volume surge. So overall, the market looks really, really bad. I had no new long signals. This is the only stock tonight. It could have been a potential long signal if we would have been higher today, let's say, and then I had the charts I had. That's not a this is not a good stock overall. Like, this is more of a bear market kind of stock, a health insurance stock, considering that everybody needs health insurance all the time. So there's no leaders moving here, and it's just ugly. I'm not going to post any of the sells because I don't want this video to run too much longer, but please go check out the new positions page and look at the sells. And if you don't happen to have any of those stocks, but if you do have some stocks, I am going through every single long position I have. And like I said, isn't it a coincidence that I have as many long positions as I did in 2007, the most ever? I'm currently tracking up right around 60 stocks. My portfolios, and both of them have about 55, which means, yes, there's 5 stocks that I'm still tracking on an end-of-day basis, but that I don't have anymore, like IQ&T. I was fully taken out of that. FOLD with that day a few days ago, I was fully taken out of that, but on an end-of-day basis, they're not full sells yet, so I'm still tracking them for everybody. Bottom line is, with 55 longs across 2 portfolios, there's going to be a lot of work tonight. I'm raising stops majorly on all of them just because this market has deteriorated quickly. What I'm going to need to start to see is my internal indicators to start to turn positive, and I'm going to need to see some better stock setups out there. Right now, they're few and far between. Remember, like I keep saying, since 2009, the one thing that I haven't seen during any of these rallies are beautiful, perfect charts. Guess when I saw them? 1996, 1997, 1998, 1999, 2001, 2002, 2003, 2004, 2005, 2006, 2007, 2008. Don't believe me? Go look at our past big winners. Go look at those patterns every single year, year after year after year. Those patterns showed up, and then I knew that I could go heavy in all of them, and that's how I made my short-term wealth, even before blowing half of it, living vicariously as a 20-year-old out here on Maui. Vicariously as in somebody that had money. I guess I should have made that point. But the bottom line is that here we are now. We still continue to have no perfect charts, no amazing looking great stocks, and yet this is what our market looks like. So we're not in a good position. Put call ratio spiked like there was a lot of fear in the market, but my God, maybe some speculators got savvy here and called this recent pullback correctly. But the bottom line is here, we're neutral on all of our market models. We're under a sell signal on the Dow Jones Industrial Average, so I want to start hedging. SDow, right now, I think I have about 5% of my... No, I have about 7 or 8% cash. I just recently checked. That means I want to split up 3.5 to 4% into SDow right now, and then also semiconductors, SOXS. This is the best tight price and volume action I can see out there in an inverse ETF to put into our cash accounts. So SOXS is going to be the position. Because of the volatility in the market, I am not going to go in and get puts on the Dow and puts on the SMH. I'm going to go ahead and just play the SOX S. I should play the SOX L in the margin account. We'll see what I decide to do, but it doesn't really matter with that one. It's both the same. But SDow and SOXS is getting 3.5 to 4% of my account capital in each, but that's because it's all that I have left. I'm raising stops on everything, and my God, it's time to take a defensive position. This is not good to see at all. It's insane to see how we've been acting since September. This V-shaped move, then the hilltop rollover, then another hilltop rollover. Then it looks like we found a bottom, broke out above 2 key moving average, and now have re-rolled over. Negative, 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 negative. It's getting uglier and uglier each time we do this. And once again, if we reverse this move and make it back above the 50-day moving average, that will even be a technically more bullish situation. But my God, it's going to leave so many charts so ugly that there's no way we could possibly gain any traction to the upside. It's going to take a lot of backing and filling before I think we really get going. So it's time to raise stops, protect our capital, and wait this market out.